Good morning, everyone, and thank you for joining us today. We're going to explore the important topic of ensuring integrity and transparency in financial reporting. This presentation will cover key principles, common challenges, and practical strategies that help us achieve high-quality financial communication. I'm excited to dive into these essential aspects with you and share insights that can make a real difference in how financial information is reported and understood. Let's get started. When we talk about quality in financial reporting, the first thing to understand is its crucial role in building and maintaining trust. Stakeholders, whether they're investors, regulators, or company management, rely heavily on accurate and transparent financial information to gauge the health and performance of a business. Without that trust, confidence in the company and the market can quickly erode. Accurate financial reporting also plays a key role in supporting effective decision-making. Leaders and investors need reliable data to make informed choices about investments, strategy, and risk management. If the information is flawed or unclear, those decisions may lead to adverse outcomes. Another important aspect is how transparent reporting promotes market stability. When companies provide clear, honest financial information, it reduces uncertainty and helps prevent market disruptions. This transparency fuels investor confidence and contributes to a more predictable financial environment. Furthermore, quality financial reporting upholds the integrity of financial markets. It ensures that markets operate fairly and efficiently, allowing investors to compete on a level playing field. Finally, quality reporting forms the foundation of corporate accountability and economic efficiency. It holds companies responsible for their actions and supports the efficient allocation of resources within the economy. In essence, good financial reporting is not just about numbers, it's about trust, fairness, and accountability across the entire financial system. Financial reporting is essentially the process of creating and presenting financial statements along with related disclosures that give a true and fair view of a company's economic activities. The main components you'll commonly see in financial reporting are the balance sheet, which shows the company's assets and liabilities, the income statement, detailing profits and losses, the cash flow statement, which tracks inflows and outflows of cash, and the notes to the accounts, which provide important additional information and context. The primary users of these reports include shareholders who invest in the company, creditors who lend money, regulators who ensure compliance, and the company's own management team. Ultimately, these financial reports serve to help all these stakeholders evaluate the company's financial health and ensure it meets regulatory requirements. When we talk about the importance of quality in financial reporting, the first thing to understand is how it ensures integrity and reliability. High-quality reports mean the information is trustworthy, which builds investor confidence and helps stakeholders make well-informed decisions. Another crucial aspect is compliance with regulatory requirements. Quality reporting helps organizations meet these standards, reducing the chances of errors or misstatements and promoting transparency. This transparency is essential because it allows all parties to clearly see the financial health and activities of a company. Ultimately, maintaining quality in financial reporting creates a credible financial environment that supports strong corporate governance and encourages investment. This credibility is key to sustaining long-term growth and trust in the financial markets. One of the most common challenges in financial reporting is ensuring data accuracy. Often, errors creep in through manual data entry mistakes or when verification processes are not thorough enough. These small slips can have serious consequences, leading to misstated financial results that may mislead stakeholders and result in poor business decisions. Another critical issue is the lack of rigorous audit trails. Without proper documentation and validation, companies become more vulnerable to fraud and face potential regulatory penalties. This highlights just how important it is to have strong verification processes in place to catch errors early and maintain the integrity of financial data. When organizations use different reporting formats and methods, it creates a lot of confusion. It becomes difficult to compare data across different entities or over time because there's no consistent way to interpret the information. Without standardized frameworks, benchmarking is much more complicated, making it harder for stakeholders to accurately assess performance or risks. This lack of transparency can undermine trust and, ultimately, increase the cost of capital for organizations. So, having a standardized approach is crucial for clear communication and effective decision-making. When disclosures are incomplete, the level of transparency drops significantly, making it harder for stakeholders to fully grasp the risks, assumptions, and contingencies that affect financial outcomes. This lack of clear information can leave stakeholders in the dark about key details that impact their decisions. More importantly, critical omissions might hide important liabilities or off-balance sheet items, which not only misrepresent the company's true financial health but also erode trust. These oversights aren't just technical errors, they can lead to serious consequences, including legal action or penalties from regulators. Ensuring comprehensive and honest disclosures is essential to maintain credibility and avoid these pitfalls. One common pitfall we often see is the misunderstanding of accounting standards. When these standards are not properly interpreted, it can lead to incorrect recognition or measurement of financial items. This mistake undermines the accuracy and reliability of financial reports, which are critical for informed decision-making. Another significant issue is the delay in reporting. Timely reporting is essential because any delay can disrupt the decision-making process for management and stakeholders. Additionally, failing to meet regulatory deadlines can harm the organization's reputation and erode trust among investors and market participants. Maintaining accuracy and timeliness in financial reporting is therefore crucial for sustaining confidence and ensuring compliance. When the quality of financial reporting is poor, it can have serious repercussions. First, it can mislead investors and creditors. This means they might make decisions based on inaccurate information, which often leads to bad investments and financial losses. Next, poor reporting increases legal risks. Companies may face sanctions or lawsuits if they fail to comply with regulations. Another major impact is damage to the organization's reputation. Once trust is lost, it's hard to regain, and this can lower market value and erode stakeholder confidence. Lastly, the financial consequences are significant. Misleading reports can result in inefficient use of capital and further financial setbacks. These factors highlight why maintaining high-quality reporting is essential for any organization. To ensure the accuracy and reliability of our financial data, it's crucial to implement robust data validation processes. This means catching and correcting errors as early as possible before they can cause bigger issues down the line. Next, adopting standardized reporting frameworks is key. By aligning with recognized accounting standards, we create consistency across reports, which makes it easier to compare and analyze information. Finally, regular reconciliation and cross-checking are essential practices. These mechanisms help maintain data integrity and allow us to track changes accurately over time and across different entities, ensuring our reports are trustworthy and comparable. When we talk about transparency and training, the first key point is to strengthen disclosure policies. This means providing comprehensive and clear information that covers all the material aspects, so there's no ambiguity or missing details in financial reporting. Next, it's crucial to invest in ongoing training programs for your financial reporting staff. Continuous education helps them stay updated on accounting principles, regulatory changes, and ethical responsibilities, which are all vital for accurate reporting. Finally, having well-educated personnel brings significant benefits. It reduces the risk of errors and ensures that standards are applied consistently across the board. This combination of transparency and training helps build trust and reliability in financial communications. When it comes to improving our reporting processes, leveraging technology is a game changer. Tools like automated data capture, integrated accounting systems, and specialized reporting software help streamline operations and minimize human error, making the whole process more efficient. Another important aspect is simplifying the language we use in reports. Clear, straightforward language ensures that everyone, regardless of their background, can easily understand the information, which is crucial for effective communication. Lastly, embracing automation offers significant benefits. It allows us to analyze data in real time and generate reports much faster, which means we can respond more quickly to changing situations and make better informed decisions. To effectively prevent financial misstatements, it's crucial to strengthen internal controls. This means implementing thorough audit procedures and regularly reviewing reporting processes to catch any discrepancies early. Equally important is embedding an ethical culture within the organization, one that prioritizes accuracy and honesty in all financial reporting. When ethics become part of the company's DNA, it sets a clear standard for everyone to follow. Finally, leadership commitment plays a key role. When leaders demonstrate a strong dedication to ethics, it fosters accountability throughout the organization, reduces the risk of manipulation, and ultimately builds greater trust with stakeholders. These elements combined create a robust framework for integrity in financial practices. To wrap up, let's emphasize why quality in financial reporting is absolutely essential. It ensures transparent communication, meets regulatory requirements, and maintains the confidence of investors and the market overall. We also need to be mindful of common pitfalls in reporting, which can be effectively addressed by implementing thorough validation processes, standardizing procedures, embracing transparency, and leveraging the right technology. Continuous improvement should be a top priority for organizations, as evolving practices help maintain accuracy and reliability over time. Lastly, fostering an ethical culture within the organization is crucial. It builds long-term trust and credibility, which are the foundations for lasting success.